It's smart to manage your taxes so that you only pay your fair share, and two ways to manage your tax burden are through tax deductions and tax credits. But those can be confusing, so what is the difference and which one's better and how do they work? The short answer is that a tax credit is generally more powerful than a tax deduction, but tax credits can be hard to come by, so understanding both of these strategies could be really helpful for you. So what is a tax credit? That's a dollar for dollar reduction in the amount of tax you owe. So if you were going to owe $1,000 on your taxes and you got a $1,000 tax credit, then that would wipe it out and you would owe zero to the IRS for that year. In fact, some credits are even refundable, so you would get money back if the credit is more than what you owe in taxes. For example, let's take the child tax credit. Maybe you're going to get a $3,000 tax credit, but you only owe $1,000 in taxes. Well, you would get that extra $2,000 back as a tax refund. But if your tax credit is not refundable, then you would not be able to get that money back as a refund. For example, if we take the Savers tax credit, this one benefits you when you make contributions to a retirement account, for example. You can get up to half of the amount you contributed as a credit, but you lose the ability to get that credit if your income goes over certain limits. So that's tax credits. Now, what about deductions? A tax deduction is an entry that reduces the amount of income that you're going to pay taxes on. In other words, you effectively report a lower income for the tax calculation. Because of that, you actually need income to use a deduction, and most people do have income because they work for a living, and even if you're retired, you might have income from pre-tax account withdrawals or pensions or something else that puts income on your return. When you have a lower income, you have a smaller tax bill, and that's a good thing. Now time for a quick friendly reminder that this is just a short video. It can't possibly cover everything, so please do a lot more research before you make any decisions. Most people use the standard deduction these days, and that's a flat number that's the same for everybody. And of course, it's different for different tax filing statuses, but it doesn't have anything to do with your actual expenses. It's a decent way to keep things simple and get a nice sized deduction, because for a lot of people, their other deductions are not going to exceed the standard deduction. So the standard deduction is the biggest option available to them and the one that benefits them the most. That said, if you do a lot of spending in certain categories or have certain things happen to you, you might have your own deductions. You could itemize deductions, and that might add up to more than the standard deduction. For example, you might have really high medical expenses due to a healthcare event and maybe some qualifying interest on your home mortgage, and when you add all of that together, it ends up being more than the standard deduction. Either way, whether you go with the standard deduction or you itemize deductions, you can reduce the amount of income you're going to pay taxes on. There are also some things that function like a deduction, but they aren't really deductions. So if you contribute to a pre-tax 401k plan at your job, for example, they're going to reduce the amount of income that gets reported on your W-2 by the amount you contribute to the plan, and that effectively lowers your income that you're going to pay taxes on, but it's not part of your itemized deductions or your standard deductions. So which is better, a tax credit or a tax deduction? And it ultimately comes down to everything else on your return. So tax credits, again, can be more powerful. In other words, a $1,000 tax credit is better than a $1,000 tax deduction. Here's an example of that. We know that a $1,000 tax credit is going to reduce the taxes you owe by $1,000, assuming you owe that much or it's at least refundable. Let's assume that you're in a 20% tax rate. So we say 0.20 times $1,000 of a deduction you're going to get. That might reduce the amount you pay in taxes by $200. So again, the tax credit would have saved you $1,000 versus a $1,000 tax deduction at a 20% rate saves you $200. What might be interesting to know is that that $1,000 tax credit is actually the equivalent of a $5,000 deduction. And we can double check that by saying $5,000 times 20% would result in you paying $1,000 less in taxes. One other way to look at that is to check out your tax form. So the deductions are going to go here on the first page, and that goes before we get to your taxable income. So the deductions, again, can reduce the amount of income that you're ultimately going to pay taxes on, and you can take that standard deduction or you can go with something else. But your tax gets calculated, and then later is when we would come in with the tax credits that actually reduce, again, dollar for dollar, the amount of tax that you're going to end up paying, and that's on the second page of your 1040. You might not actually use a paper form to file your taxes anymore, but this can help you visualize the order of events. Remember that there are some other ways to manage your taxes as well, not just tax credits and tax deductions. So for example, you could do tax efficient investing. So that might be sort of a more passive approach where you're not going to have as much turnover, not going to take short-term gains as often. You might even invest in municipal securities if that's going to help you, but that's something you really need to look closely at. And you can also do some tax planning, like maybe doing Roth conversions in certain years when you have low income so that you can fill up certain tax brackets as you move through life. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.